Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. These are 10 reasons why silver will explode. Gold and silver have never been shinier as they are now. This link from Seeking Alpha will be in the description. It's definitely a very good, well-written, educational, informational article. You definitely want to check this thing out. I'm excited to share this video with you guys. So before we start, make sure to smash that like button. Make sure you subscribe because I post daily videos. The stars have aligned perfectly for precious metals. We don't recall a time where all drivers were supposed to be pushing gold prices up as it's now. Silver, on the other hand, is suffering from dual status. The industrial aspect of it's overshadowing the safe haven aspect that it offers, just like gold. We like them both, but the gold to silver ratio trading at an all-time high, suggesting that gold might continue to have the upper, shinier hand over the short term. Keyword is short term, though. We expect precious metals to keep pushing higher. Over the longer run, silver may play a catch-up with gold, and history suggests that this might be for a worthwhile ride. The gold for the short run, silver for the longer run, but more than anything, we hope for shiny precious metals to lead the way for all of us to be backing shiny, happy people. So, this is a very good article. As a result of the coronavirus outbreak, we are witnessing things that we haven't seen in years or ever before. One on hand, Wall Street just closed for the first 3 months of the year down 20%, the biggest quarterly drop since 2008 financial crisis, and this is what it's starting to look like is happening. This credit crisis, which led to $50 silver, ladies and gentlemen, $50. On the other hand, the Fed and the U.S. administration are pouring many trillions of U.S. dollars into the systems. These are unprecedented times, and this is exactly the setup that make precious metals an asset class that many investors are interested in, mostly as refugee, a place where they can park money, hoping that, one, it will be able to preserve its value against inflation, and two, won't be subject to the extreme volatility that stocks and even bonds are subject during troubled times. In this article, we are focusing on gold and silver, looking not only at the difference in their performances, but also the main drivers behind each one while trying to understand if there is performance for one other right now, as well as in the long run. As a preliminary observation that you may find valuable to know is that over the past 18 months or so, there was a clear shift towards preferring the real thing, example, physical holdings of underlying assets. Generally speaking, over the long run, investors would prefer holding the physical ETFs over virtual ones. Putting it differently, the longer period you look at it, the more likely it is for ETFs hold precious metals physically to outperform ETFs that it's supposed to have ownership rights but not possession over the amount of gold and silver they hold against their AUM. As much you may expect over time, Sprott Physical Gold Trust will outperform the SPDR, the gold shares, as well as Sprott Physical Silver Trust outperform silver shares, SLB. So the recent history of precious metals, as you can see below, while the SPDR and the S&P 500 Trust tanked 20% during the fourth quarter of 2018 until Christmas, precious metals have performed very well. This is a classic example of safe haven status as they benefit from. So nevertheless, even between 12/24/18 and 2/19/2020, when the bull market was roaring higher, precious metals haven't lost their allure. True with the exception of Powell, they were all lagging behind SPY's 44% return, however, still delivered a very consistent return in the mid-high 20% level across the board, gold, silver, platinum, you name it. So, as we all know, stock markets peaked 2019-2020 and have lost a lot of ground ever since, up to 35% at some point last week. How did precious metals behave during that tough period for stocks? Well, this is where things become quite interesting and unique. While gold is holding up fairly well, not climbing but still holding still, the rest of the precious metals backing is performing almost as bad as the market. Moreover, as much as we already got used to see platinum and palladium deviating from the pack, the underperformance of silver compared to gold is significant. It may not be so unusual to see that happening principally, but the magnitude of the underperformance, SLV is 20%, 23% lower than GLD, and the pace over a period of 6 weeks are rare. So, as you can see below, in the late 2016, early 2016, the blue and red lines representing the GLD and SPY almost touched each other. The same thing has happened in the mid-late 2016 when the orange-red lines representing the SLV and SPY almost kissed. Nonetheless, while gold has managed to keep pace with stocks, silver's completely lost touch. Why is this divergence so significant? So the main drivers behind gold and silver, this is where we get into the meat and potatoes. Interest rates. Precious metals pay no interest, so holding these come with a cost that is equal to the risk-free rate only one can have by putting money in the short-term U.S. government bond or a bank deposit. The lower rates yields are the lower alternative opportunity cost that purchasing precious metals being non-interest-bearing assets comes with. Over the past year, that alternative cost has almost disappeared, making the decision to buy gold and silver much easier. Number 2, the U.S. dollar. Most of precious metal trading volumes are in U.S. dollars. Since gold is an asset that is held by many countries and central banks as part of their reserves, the cheaper price of the gold in USD, the bigger the purchasing power of the major players becomes. As such, precious metals are negatively correlated with the greenback, like when the dollar index is higher, gold and silver is lower. When the dollar index is lower, gold and silver are higher. So that's kind of what I just explained in that next paragraph. So although recent weeks the USD has been increasing considerably in light of the USD liquidity stress shortage, the DYX index hasn't moved much since the end of 2016. So 3, inflation expectations. Widely considered to be a good tangible hedge against inflation, prices of precious metals tend to move in line with inflation expectations. While the Fed's balance sheet is exploding like nothing we've ever seen before, it's near certainty for inflationary pressure to pick up in the coming months. So number 4, geopolitical tensions run to safety. Precious metals, especially gold, are benefiting from safe haven status, right? Gold and silver are seen as the safe haven place to park your money. And at a time of increasing uncertainty levels, many investors are seeking the safety that mostly the yellow metal offers, because gold is seen more of a safe haven, silver is more of an industrial metal. Wherever geopolitical tensions rise or virus outbreaks spread, that for the matter, you can count on a run to safety that gold is likely to be one of the main beneficiaries from. Gold is a safe haven. So, and when stocks are taking such a dive, and so quickly, it's only natural for people to run to safety, and a trend that is expected to push precious metals prices higher. So 5, economic growth. During an economic expansion, people tend to take more risks, spend more, and need demand for safe assets is declining. During an economic contraction, people tend to take less risks, spend less, and need demand for safe haven is rising. According to all forecasts, the U.S. economy is already in a deep recession, with the GDP expected to push the deepest quarterly decline since quarter 2 of 2020. So number 6, supply and demand. Very good reason. Probably one of the biggest drivers, the biggest price manipulators. So there's a good reason why this is only being mentioned here and not part of the main drivers that affect both gold and silver. Immunity. Unlike silver, gold is not affected by global supply and demand forces, mostly due to its dominant safe haven status. Contrary to that, silver is being viewed and measured as an industrial metal, just as much, if not more, than its safe haven status. As such, silver's supply and demand forces are having much greater impact on silver than they have on gold, and that's because of its industrial use. However, this industrial and precious metal dual perception might actually benefit silver soon, because the production is taking a hit due to COVID-19, and rather than a shortage of supply that might be felt. So COVID-19 effect on monthly silver production. You can see that the world production offline is very, very large, and Peru's actually shutting down. We know China's in back order. Mexico's the only other one that's really doing anything, but they're even shutting down mines. So reserve currencies, number 7. Unlike gold, silver is not being used as a reserve currency held by central banks around the world. The ability of most central banks to print money almost as much as they want also means they'll have the ability to keep buying gold if they do wish for it. So in tons, USA's number 1, Germany's number 2, Italy's number 3. So 8's the gold rush. Assets under management for gold ETFs are much bigger than those of silver ETFs. Silver's a much smaller market than gold is. As more people are buying precious metals ETFs, there's a steadily increasing demand for gold and silver, but mostly for the former. So while ETFs have increased substantially, there's one investing silver at the bottom of the pack with a positive small increase to their AUM over the past 5 years. So gold and silver ratio reflects extreme risk aversion. The dreadful macroeconomic environment has set the tone during the first quarter of 2020, turning risk aversion into the single most important factor determining the fate of all assets. Anything is cyclical, aggressive in nature went down sharply, while non-cyclical defensive assets have fared better and sometimes even benefited from the run to safety. So There's a lot. And can this continue? For the short, simple answer is yes. Not only the gold to silver ratio can move higher mathematically and theoretically, but it's also being supported by technical and fundamental drivers. Technically, the ratio has broken any resistance level that stood in its way, no matter what time frame is the chart you're using. Fundamentally, COVID-19 keeps shutting down the world's economy, and risk aversion continues to dominate investor sentiment. Therefore, it's not hard to see the gold rush accelerating further. So it's going into stuff I've talked about previously. The 2008 crash that led to $50 silver in 2011, and there's a lot of patterns. So here's the bottom line: the stars have never been aligned. The stars have never been aligned positively, perfectly for precious metals as they are now. It's safe to say they're not even a good reason to refrain from buying gold, mostly in silver right now. Low rates, low yields, monetary policy that pours trillions into banking financial systems, fiscal policy that pours trillions into the economy, investor sentiment, risk aversion, run to safety, inflationary pressures, disruptions to the supply chain, you name it. At the moment, those are the safe haven status and perceived hedge against current turmoil. They are providing gold and silver tremendous boost in support and potential. So, however, even when the world does overcome COVID-19 and things start to move back to normal, there's no reason to assume gold and silver won't lose their allure. So I'm definitely I'm glad I found this article. It's very informational. We're expecting higher prices for gold in the near future. We also expect silver to start playing a catch up in the foreseeable future. So where does this lead you? Where do you think this all is? I mean, do you see the reflection? Do you see the same patterns as the 2008 credit crisis that led to $50 silver? Do you think the same thing's going to happen? I mean, right now, the same thing could happen, but we're living in extreme times, so expect extreme prices. We're living in crazy times, so expect crazy prices, right? $100 silver is not out the realm of impossibility. It's definitely possible and plausible because of what the time is we're living in. COVID-19 is making a huge disruption in the supply chain, and we know that silver demand is needed, especially for the industrial side of things. So anyways, I'm going to wrap this video up here. The link to this article will be in the description. Make sure you smash the like button, subscribe. If you already haven't, I post daily videos. I posted 3 other videos a day, so stay tuned for those. Go check those out if you missed them. Yes, that's 4 videos in one day. I'll also be posting a video in the morning, so stay tuned for that as well. This was Silver Slayer. I'll see you guys soon. Peace.